Welcome to It Depends, a sales tax podcast by TaxConnex. I'm your host, Brian Greer, joined by my colleague, Jeff Meggs, and we're super excited that you've joined us today. Sales and use tax can be confusing and overwhelming, but it doesn't have to be. Whether you work in an industry or a CPA firm, or just someone who wants to stay informed about the latest sales tax laws, we've got you covered. Periodically, we'll explore different aspects of sales tax. So whether you're a tax pro or a novice, in industry, school, or a practicing CPA, tune in and join us as we attempt to simplify the complexity of the sales tax world. This is It Depends, because with sales tax, there's rarely just one answer, and often that's our answer to many questions. It just depends. Just to provide you a little bit of perspective, if you're not familiar with our organization, we do focus very specifically in the sales and use tax space. I would consider TaxConnex to be more of a professional services firm with this kind of niche focus in sales and use tax. And there's two primary service areas that we have. One of them, Jeff heads up as our consulting practice leader. But within that consulting business, we spend a lot of time helping companies figure out what are they supposed to do from a sales tax perspective. So that incorporates a lot of different questions and issues, but tends to be focused in Nexus determination, taxability reviews, exposure analysis, a lot of which we're going to be talking about today with you guys. And then the second practice area of the business is really more of a compliance outsourcing service area. So essentially, we become an outsourced sales tax department for our clients. Kind of think of it as maybe a fractional sales tax employee where we just manage the entire process for you rather than have that employee in-house or managing it yourself. From a agenda perspective, what we plan to talk about, I mentioned the kind of that consulting area that Jeff heads up, but we want to start with, and a lot of times our presentations start with this Nexus concept, just to kind of level set everybody. And we think it's very foundational to understanding the sales tax requirements as well as the potential risk for the business. So we're going to talk about Nexus. The second kind of building block is taxability. Specifically whether a state subjects your specific revenue streams to sales tax. We'll talk about that a little bit. And then also talk about, how do we go about at least estimating what the exposure is. You'll understand that at this stage of the analysis, we're not trying to be super precise. We're just trying to get a directionally accurate representation of what the exposure might be on a state-by-state basis so that we can talk about and consider different remediation options. And that's the third bullet point in terms of, what are some of those options? A lot of you are probably familiar with voluntary disclosure agreements. We'll talk about that a little bit and kind of wrap up the discussion with a audit overview, what triggers the audit, what you can do during the audit, some tips and tricks to manage the audit more effectively on your side.
Well, I hope that those of you that are advanced or intermediate don't find this too drawn out. Do want to kind of revisit or kind of summarize sort of Nexus from a sales tax perspective. As Brian said, it's a primary factor. It's really the starting point for a discussion or an analysis of sales tax risk or exposure. So when we talk about sales tax nexus, what we're really saying, nexus is a connection. And in the case of jurisdictional nexus and sales tax nexus, it's a connection with a state that allows that state to impose its taxing authority on you or on the company. So if you don't have nexus, you don't have a requirement to comply with the sales and use tax laws. So naturally, it's a good starting point for sort of establishing whether or not there should be any concern. And historically, going back to, the 60s, 1967, I believe there was a case in Illinois that kind of set precedent for Nexus for sales and use tax purposes. And for those 50 or so years, we had lived under the premise of physical presence was a requirement to have Nexus. So without physical presence, without an employee in the state, without an office in the state, without some level of physical activity, and it doesn't have to be a permanent employee, it could be someone traveling into the state to perform a service or to solicit a sale. Those were the standards by which sales tax Nexus were established. And so the big change, and it was huge, that sort of turned us all on our heels was the Wayfair decision in 2018. The state of South Dakota had legislated an economic presence standard. They set forth a threshold of $100,000 in gross receipts during a calendar year, or in excess of 200 transactions in a calendar year, and asserted that would establish Nexus and a requirement to comply with the sales and use tax laws of South Dakota. When they wrote the legislation, they actually included in it a expeditious way to litigate, so that everybody wasn't sitting around wondering, is this for real? Is this really going to be upheld by the courts? And so ultimately we had a challenge to that legislation. That was Wayfair, an online home goods store. And they took this to the South Dakota Supreme Court, which interestingly ruled in favor of Wayfair and said it was unconstitutional. The state of South Dakota, along with a number of other states that were closely watching and monitoring this, asked that it be heard at the U.S. Supreme Court level. It was heard. Arguments were heard in April of 2018, and the decision came down, I think, 5-4 in favor of the state of South Dakota in June of 2018, thus sort of establishing an economic nexus standard. And the decision by the U.S. Supreme Court certainly didn't set in place law. It only served to validate the legislation and the law within South Dakota. But as you might imagine, and as we now know, all of the other states were eagerly awaiting this opportunity to sink their claws into this vast market, this economic marketplace. And so the laws just came rolling out of each state over the course of the next year or so. Today, all of the states that impose a sales tax have some level of legislation enacting an economic nexus standard. There are 5 states, those of you that are intermediate and advanced already know this, but there are 5 states that don't have a state level sales tax, those being New Hampshire, Delaware, Montana, Oregon, and Alaska. And what's unique about Alaska is they do have cities that have their own sales taxes within the state of Alaska. And in fact, they've enacted their own version of an economic nexus standard at the city level that kind of looks similar to all the other states. What I would say to you in terms of what is the economic nexus standard is I would have in my mind a $100,000 threshold. The overwhelming majority of the states are legislated to set the standard at $100,000 in gross receipts during a calendar year. There are some exceptions to the rule. There are some nuances. Some of the jurisdictions, or a lot of the jurisdictions, also have that 200 transaction threshold, but not all of them do. And then there's a few that their standards are a bit higher. So Texas and California have a $500,000 threshold. Mississippi and Alabama, I believe, is a $250,000 threshold. But the rest of the states generally fall into that $100,000 category. So when I talk to clients, I just advise them to use the $100,000 threshold as sort of the mark version that they monitor. And then when they hit that in any given state, do a more detailed review and determine whether Nexus has been triggered.
And Jeff, one point with this that seems to oftentimes be confusing is that the economic nexus standards did not replace the physical presence standards. It's added like another layer onto it. So while the economic nexus standards are pretty clear cut, it's a bright line distinction, you still have the physical presence issues that you have to deal with, and which tend to be a little bit more interpretational.
Yeah, no, that's a good point. So Nexus, again, is sort of that first step. Let's answer that question. It's usually a little easier to answer the question as to whether or not Nexus exists. And if the answer is yes, we then take a step further into the analysis or discovery of whether or not we have any risk. And the next piece of that is taxability. Are we providing, selling tangible personal property or providing services in the state that would be considered taxable? And generally speaking, all of the states, except for those 5 I mentioned, all of the states have established that the sale of tangible personal property is a taxable event, absent any specific type of an exemption. And so that's sort of the baseline. And then in addition to that, many of the states will also have some level of tax treatment on certain types of services. But that varies drastically from state to state in terms of the scope of services that might be found to be taxable. But I think as we go down this path, we answer that question of Nexus, and then we lay out our primary product and service categories. And in those states where we have Nexus, we start to ask the question, is that a taxable event? And we'll get into customer discussion here in just a bit relative to exemptions. But the one thing that I do want to touch on is in the service element, or on the services side of things, and even to some degree on the tangible personal property side, it is important to understand the citing rules for sales tax applicability. And what I'm really referring to is, let's say I'm selling a software as a service, and my customer is headquartered in New York, so I invoice them in New York. But in reality, all of the seats, the users of that product, are spread out across the entire country in multiple states. So in those cases, what we're looking at is determining where the benefit of use occurs. And in a SaaS product delivery, generally that's where the seat is located, where the user is located. And so citing rules can be challenging at that level. When we talk about sales of tangible personal property, they're a little more black and white, a little more ascertainable. And usually it's where title transfers or where possession transfers. It can get quite complex when you get into varying types of shipping terms and delivery options. But generally speaking, if at a high level in an e-commerce scenario, you're usually dealing with destination. So wherever the customer is located, where they're receiving the property, is generally the situs for the sales and use tax.
And that term generally is key there. And we won't get into origin-based states today, but that's a factor to consider as well.
Yeah, the two terms that are my favorite and most used are generally and it depends. Those are my standard boxed answers for everything. In fact, Brian he and I talked about something earlier today, and it seems like you'll get into a discussion with a taxpayer and they'll have expressed to you their business model, their activities. Seems really, really clean and straightforward. However, there are usually nuances. There's usually something in there that makes them unique or special that might change the tax treatment. And so we commonly find ourselves peeling the onion back quite a bit. So now we've established that we have Nexus in some number of states, maybe just one. We've established we've got taxability. In other words, some of our products or services are taxable, at least in some of the states where we have Nexus. Those two things combined tell me I've got a responsibility to register as a sales tax account or a sales taxpayer, and I've got to comply with the sales and use tax laws, at least prospectively. And we'll talk a little bit about retroactively here in this particular slide. I touched on this in our prior slide about the customer base, and what I was really referring to is you may have exempt sales. And so when we talk about the taxability of your customer base, that's generally a topic that involves resellers. So if you're selling inventory and you're selling, Hoover vacuums to Walmart, Walmart's likely buying $100,000 or 100,000 units of those every year or more. They're putting them on their shelves for sale at retail to consumers. They're going to issue a resale exemption certificate to the distributor or the manufacturer on that purchase. It's going to be exempt from sales tax. Other examples might be nonprofit entities. There are a number of states that do tax nonprofits, so it's not a blanket exemption that exists everywhere, but a lot of states do afford nonprofit organizations, particularly those that are delivering charitable, religious type services to the community. They afford them a sales tax exemption, and they're able to get a document that they can issue to their vendors for that purpose. There's also state and local governments or federal governments. If you're focused, or at least a primary customer base includes those types of entities, most of the time, state and local governments are exempt from sales tax, but not always. Always, sales of tangible personal property to the federal government are exempt from tax. So all the states, the federal government has exclusivity in that regard. So again, we made the determination on Nexus. We've made the determination as to whether our products and services are taxable. And now we've gone through our customer base and evaluated and determined what level of exempt status might exist in that customer base. But ultimately, we came to the conclusion that not all of our customers are exempt, and some of our products and services are taxable, and we have Nexus. We have some prior period risk, some prior period exposure, perhaps. And the way the sales tax laws are structured, it's generally the responsibility of the vendor to charge, collect, and remit the sales tax on an intrastate transaction. So when you walk into Walmart, and I don't mean to be using Walmart in a negative fashion here, it's just an easy example we all can relate to. But when you walk into Walmart and you pick something up off the rack, take it to the front, it is their responsibility to calculate the applicable sales tax on that transaction and charge it, collect it, then they subsequently report it and remit it to the state. If they fail to do that, if they fail to apply the appropriate sales tax, they remain liable and exposed for that tax. So if they were to be audited and that transaction were identified by the auditor, they would assess Walmart for the tax on that transaction. There is also what we refer to as a use tax. So when we're talking about sales and use tax, you hear those terms used sort of in combination with one another. They're really two different taxes. The sales tax is generally an excise tax that's imposed on the retailer on an intrastate transaction. The use tax comes in two varieties or two flavors, one being a consumer's use tax, which many of you might be familiar with. You buy something over the internet, the vendor is located in another state, and this is, more relative back beyond Wayfair. They ship you the product, they didn't charge you tax. As a consumer, you have a responsibility to self-accrue and remit that tax and report it to the state. And that would be a consumer's use tax. And then lastly, there's what we refer to as a vendor's use tax or a retailer's use tax. And that typically applies to an interstate transaction where the inventory or the order is approved outside the state and the product is shipped inside a state. And at that point, we look to the vendor primarily, and if they had Nexus, we would expect them to apply, charge, collect, and remit the sales tax. It would be considered use tax in that scenario, but that's who would be the responsible party. However, in a use tax scenario, if it's retailer's use tax, the state can actually approach either the seller or the purchaser and assess at either place. So whichever one they get to first, they can assess and assert that entity has the requirement to pay the tax. And it's a little bit of a flawed system because ultimately they could audit both parties, and unbeknownst to both parties, they could both be assessed that tax and both pay it, and state benefits from that. So those are sort of some of the components of what we're trying to manage and understand. As we consider our risk and our prior period exposure, we tend to look at sort of two levels of what I call a look back period. One is the general statute of limitations, and in most states that's 36 or 48 months. There's always exceptions to the rule. However, in this particular case, what we're talking about is a taxpayer that has never been registered. They're just now defining their Nexus footprint and their taxability requirements. And so there is no statute of limitations. So virtually any transaction they encountered from the time at which they originally established Nexus is within statute. The state could come in and assess. Administratively, the states generally don't go back beyond 7 years. Sometimes they go as far as 10 years. As long as there's not some intentional negligence, they tend not to go back much further than 7 years. As we're talking through this, and as I'm sort of setting these standards of kind of managing risk, we are talking about a company or an entity that has established Nexus, that does have taxable products, but generally has not charged sales tax to date. They haven't put any tax on an invoice and collected it. That's a whole different level, and I may talk about that here in just a little bit, but they are two very different things. If you're non-compliant and you haven't charged sales tax, you're treated much more fairly, I would say, than somebody that's collected and not remitted sales tax. As we start to think about estimating and calculating our exposure, I talked a little bit earlier about risk quotients. How likely is it that I'll be identified for audit? How likely is it I would be assessed for these liabilities? I think overall, we tend to start at a macro level, and we tend to look at sort of take average sales tax rates and apply them to our gross receipts that we believe to be taxable. And we try to calculate an estimate of what that liability looks like. Is it material? And at the end of the day, materiality tends to drive most of those decisions. But in addition to that, materiality then leads to risk assessment. How likely, like I said, is it that I might get identified or assessed? If you're not going through any kind of merger or acquisition, then you can roll the dice a little bit. You can take a look at your overall exposure, and particularly if you've determined you have Nexus in a number of states, you can start to average out that risk and find that it won't be as bad as you think. It'll look bad on paper, and we all kind of fall into this scenario of whatever we see, we can assume that the departments of revenue also see. But as the gentleman asked earlier in this presentation, how do they know? And how do they know I have Nexus? How do they know I have any taxable transactions? How do they know all of my transactions aren't exempt for resale? Those are valid statements and questions, and they generally don't know until they audit you. So let's talk about mitigation options. So we kind of went down this path of establishing that we do have some prior period risk, and we at least would like to understand what our options are. And our perspective is that there's really three primary options for you. One is simply to say, look, I've got this prior period risk and exposure, but I haven't charged or collected any tax in the past. So I'm not holding tax in a fiduciary capacity for any state. So I might think about it in terms of prospective compliance, meaning I'll just register effective today, and I'll start charging, collecting, and reporting on a prospective basis from this point forward. That has some obvious challenges and risk associated with it, but it's a very common exercise. I was on the phone last week with the Pennsylvania Department of Revenue, and I actually shared this with them. There were two assistant secretaries for the department, and I said, our philosophy is voluntary compliance is the key for all the states and all the taxpayers, in the sales tax world especially, because at the end of the day, the objective in a retail sale is to pass that tax on to the consumer. So if you guys are managing businesses and you're making sales of tangible personal property or services that are taxable, the faster we can get that tax onto my consumer, my customer, and put that burden on their shoulders, the better off we are. Ultimately, that burden is always theirs, whether you charge it to them or later on, if they're subject to consumer's use tax, they might get audited and assessed for it as well. The intent of the law is for that consumer to have that potential liability. So what we talked about with the department was some of our clients find themselves in a little bit of a dilemma. They have prior period exposure. They knew they had Nexus 5 years ago, and they aren't in a position to satisfy that prior year risk. They don't have cash just sitting around to liquidate that risk. But at the same time, we don't want them to bury their head in the sand and just say, I'm just going to wait until something drastic happens. We encourage them to go ahead and register and start filing prospectively and collecting. And the idea there is simply, look, there aren't really any options that a taxpayer without cash can take care of prior periods. And the state benefits if we can kind of get going and charging tax, passing on the consumer going forward. So that's the most common scenario for us is prospective compliance. In terms of prior period mitigation, one option is simply to register reflecting to the state that you had Nexus a year, 2 years, maybe 3 years ago, and tell them that in the registration. The application for registration for sales tax is going to ask the question, when did you have Nexus or when was your first taxable sale? And if you put a date prior to today or sometime in the future, the state system is going to automatically generate notices for all those periods that you had Nexus and a responsibility to file. So you're going to have to file prior period returns under those conditions. And if you have liability in those periods and file accurately, you're also going to be incurring some penalties and interest associated with those. It's not a very common exercise for us with our clients to go down that path. We usually, most of the time, we find ourselves in the first scenario, prospective compliance. But periodically, we engage in what's called a voluntary disclosure agreement. We call them VDAs. And the whole decision tree for any one of these scenarios is a combination of those things we've been talking about. Cash flow, how material is this risk and this liability, and how long and how far back does my Nexus go? If I didn't have Nexus but for the last 2 years, then that mitigates some of my potential risk and liability for some of the older periods potentially. And it makes for a cleaner sort of process to go forward prospectively. So as we look at the registration and prospective compliance, it's primarily driven by materiality or cash position. I will tell you that if you are going through a merger and acquisition, these options aren't necessarily going to be available to you. Whoever's doing due diligence on that purchase is probably going to come down on the side of, I'm not inheriting any of your liabilities. We're going to calculate them and we're going to either escrow them, you're going to just lose that out of the purchase price, or you're going to mitigate them yourself. Most of the time, the purchaser requires they be mitigated. And that leads us down the path of the VDA. So when we look at voluntary disclosure agreements, the real advantage to them is what we call a limited look-back period. So I've got $200,000 in estimated risk in the state of Georgia, and I'd like to go forward and enter into a voluntary disclosure agreement to mitigate that risk. I haven't charged any of that tax, and the way that tax liability breaks down is it's $40,000 of tax over the last 5 years. Well, if I enter into the VDA program, and first of all, to qualify to participate in any VDA program, you can't already have been registered. You can't already have been notified by the jurisdiction for any of those tax liabilities. So we're presuming in this case that I haven't fell into either of those two traps. So I go to the state, I engage in this VDA agreement process, and they immediately agree to both waiver of penalties and what's called a limited look-back period. 36 months is as far back as they'll look. So they're right away forgiving $80,000 of my tax, assuming it's $40,000 spread evenly over the 5 years. And they're automatically giving me penalty abatement. That can be attractive to a lot of companies to kind of figure that out and get sort of a clean bill of health going forward. It's very attractive if somebody's sort of starting down a path of looking to be acquired and they want to just clean up things in-house. They don't want due diligence coming in and identifying them as having some sloppy records or non-compliance. So it does sort of, if you have that agreement in hand and you've gone down that path, you can show an acquirer or potential acquirer that we're clean. We've satisfied our liabilities and we're on the track to compliance. As I've talked about or alluded to, as we've talked about the VDA, there are certain sort of exercises we'll go through as to whether or not a VDA is right for your company. Again, that limited look-back period, from my perspective, is the overwhelming benefit of a VDA. I want my clients to have a lot of tax exposure in years 4, 5, 6, and 7 and not have charged or collected any of that tax. That to me is a premium opportunity to enter into a VDA. I get a lot of bang for the buck in that scenario. The scenario where you have collected tax and not remitted it, you don't want to be in that position under any circumstance, particularly if it's material. And if you've got some material tax collected, there is no limited look back if that's the case. So if you collected tax 5 to 7 years ago, you can't leverage the VDA to get out of that. You've got to disclose it and pay it. So anytime our clients are in a position where they've collected a material amount of sales or use tax, we're almost automatically going to go down the VDA path. And as I've already kind of commented, any time you're going down a path of looking to sell the business or take on investors, you should assume they're going to do some level of due diligence. And in the past 5 to 7 years, Brian and I have heard a lot of stories about due diligence, mergers and acquisitions actually failing because of the sales tax exposure that existed in the business. And what's really interesting and important to understand is that more often than not now, that sales tax due diligence effort is included in the process. Used to be they looked maybe at income tax, maybe some payroll, and then everything else was really financial. And sales tax, almost every time we look at a company going through due diligence, sales tax is addressed at some level. So this last section, we're going to talk about audits. And on the heels of that last sort of commentary about materiality, our business model is focused on small to mid-sized companies. So when we're giving advice or giving recommendations to companies, it's important to understand these are companies that are either in their infancy of development, or they're at low revenue stages, or they're in rapid growth. And some of them can get into the hundreds of millions of dollars, and there's substantial material risk there. But this is different than working with a publicly traded company or advising a publicly traded company, or to Brian's point, a really sophisticated company that has a cultural values requirement that compliance be done at 100%. What our philosophy is, we're trying to help companies get into compliance. And we understand there's a practicality element to that. And then there's a clinical, statutory, legislative element to that. We try to balance the two and give an equitable response or advice. So I want to talk a little bit about audits. We're not going to get too in depth with the audit discussion today, but I would have said, and by the way, I think you may or may not know this, but I have a little bit of audit experience. I was an auditor with the state of North Carolina in the early 1990s. And back then, I would tell you that most audits are conducted based on other audits, companies that have been audited, and we as auditors would see invoices that just looked a little suspicious. and it would lead us down a path of investigating and ultimately auditing that other company. Certainly, if I've been audited in the past and I didn't have good results, the likelihood is the state's not going to forget you, and they'll come back and see if you still got some more candy to hand out for Halloween. Audit cycle, if you're a really, really large taxpayer, you're probably on some level of an audit cycle. If the volumes are so massive and your history is such that they're just every 3 years. In fact, some of these audits take 3 years, so they just never end. You're just constantly in an audit cycle with them. Every once in a while, there'll be a need for the state to really focus on an industry. There might be an industry segment that's kind of taken liberties with the sales and use tax laws, and their interpretation is appearing to get a little wild. So they might focus on those industries just to kind of get people back in line with what the legislative intent was. And lastly, there are hotlines that these states have. Sometimes you'll get a disgruntled worker that wants to make life difficult, or it's a customer that just has a problem. There was 20 cents more on their tax calculation than they believe they should have to pay, and they're going to take it up with the jurisdiction or the state and call you in. So every once in a while, there's those sort of spurs that kind of catch you by surprise. As far as what to do if I've been contacted, usually the way it happens today, the majority of the audits we're seeing are done remotely, just electronically. So we'll get a notification. Sometimes it'll come in snail mail. A lot of times it'll come electronically to the taxpayer, and they'll say, we have intent to audit your business for this period of time for these tax types. It shouldn't be surprising that if you are getting audited for sales tax, it's very likely you'll also be audited for state income taxes and potentially some other state taxes, if depending on the state. What I encourage companies to do even before audits start, but essentially once I get that notification, I want to immediately start to evaluate my records, accessibility of my records, quality of my record retention. Do I have what I need that is likely to be asked? You're going to be receiving a list of requests or document requests that are onerous. You're going to see 20 or 30 pieces of information that they ask for. What I would tell you is that they don't necessarily need all of that. They just aren't sure what they're going to need until they get into it and start looking. So they a lot of times ask for it all up front. What we tend to do when we're managing audits on behalf of our clients, we kind of have a pretty good feel as to what is necessary to conduct the audit, namely purchase records, sales records, invoicing, and we'll provide those key components that we think are necessary up front, and we won't go to any extra effort to supply things that are a little bit further down the list. Sometimes that works favorably for us, sometimes they just don't. They're relentless, and we end up having to provide it. But I'd say 80% of the time, we avoid having to provide 100% of what's requested. I think it's important to think of these audits just as a business transaction. As painful as this is in some cases, and I will tell you, there will be times when you'll deal with an auditor that has no business being in the audit business. They're not professional, they're not taking their job seriously, and it can be very painful for you. I still believe it's probably in your best interest to just treat the auditor with respect and get through the process. If the auditor is not worthwhile, you can take it to a different level and try to mitigate. Have control over what the auditor is seeing. Don't just give them access to a room full of records or a database, online database full of records that they can kind of sift through. Be very precise in what you provide them and only provide what specifically they've asked for. Keep the relationship to one-on-one. Don't have multiple people in your organization fielding questions from the auditor. Don't give the auditor access to anyone other than a primary contact. And then the last piece is, if you've got something you know is going to be identified, and maybe you have multiple items that are going to get identified, and you feel pretty confident the auditor is going to stumble across them, you might take the stance of just introducing or disclosing some of the more benign issues and just trying to build rapport with the auditor and share with them, look, we're trying to do the right thing here. We know we've got a couple of purchases we didn't pay use tax on, so we wanted to show those to you, and we're doing our best here to get things covered and applied in the right way. The last piece of this equation is, what do I do once I've gotten an assessment from the state? There's usually a number of different things that have happened during the course of an audit. It's common that you'll get what we call work papers at periodic levels or timeframes within the audit. Some of the auditors are very good about that, and they'll kind of share with you what they're seeing, what they're finding. It gives you an opportunity to start your mitigation efforts. Let's say you're missing some exemption certificates. They may introduce that fact to you early enough that you can go out and recover exemption certificates to substantiate those exempt sales. I think a lot of audits, particularly the larger the company, the more likelihood you're going to be going through a statistical sample or just some type of sample and projection. It's really important to understand what that means in a sales tax world and how adequate and satisfactory projection needs to be calculated. So these are areas that you can spend a lot of time in. I think you'd probably want to get some help with something like that. I do want to point out XYZ letters. It's really a phrase that's used in the sales and use tax world. It doesn't really have a meaning. It's essentially an affidavit. And what it does is, if I've sold tangible personal property to a company, and that company has already satisfied that tax liability, I failed to charge them tax, but they went ahead and self-accrued it and remitted it, or perhaps they were audited themselves and assessed. They can execute this XYZ letter, and it's really just a form letter that you draft on your own. There's no form you're going to go out and find in this regard, but you're just asking specific questions. They're checking boxes. They're telling you they already paid it. They give you enough detail to substantiate the payment's been made. If they've been audited, they might give you a copy of the audit or a copy of that section of the audit, and then they're going to sign and date it and return it to you. Those, a lot of times, just go a long way to mitigating some of the liability. Validating projections, again, is kind of an art to some extent. A lot of the states and larger taxpayers, they're going to be going through statistical sample audits. Those can get a little complicated. The good news is they're typically handled by someone other than the auditor. There's usually an IT person in the background that's sort of mechanizing the process and making sure it happens the way it should. And last thing, once you get to that final piece of the assessment, and the auditor said, that's as much as I'm going to give, everything else on here is assessed, and I'm not going to do anything more, there are still options. You can request a meeting with the audit supervisor. You can file a formal or maybe an informal protest or request for hearing with the state. And that could go, again, to an informal level. And ultimately, if you're not making progress and not getting what you need, it can go to a more formal level. But at a certain point in time, you'll be forced to engage an attorney, potentially a CPA, but usually an attorney, to take it to the lengths at which you might need to. I like to say that auditors don't want conflict. At the end of the day, they want you to accept the audit. So I think there's always room for negotiation in the work paper stage, in the preliminary assessment stage. Take advantage of that if you need to. And working with the auditor and building that rapport and treating them with respect early on usually leads you to a better result when you're trying to negotiate at the end.
Thank you, everyone. Bye-bye.
This has been It Depends, with another episode explaining the complexities surrounding sales and use tax. We'll see you next time.